Hi, everyone. Yeah, sorry I can't be there today with you guys, but I'm excited to be giving this presentation. We'll be walking through a bunch of different components of token launches, and I hopefully by the end of it you'll have a good sense of kind of the complexity of the problem, but also confidence in the idea that there is a kind of pathway through. So in my role here at Andreessen, I work with all of our portfolio companies and try and keep them on the right side of the law. Before this, I was a partner at Latham & Watkins, which is a big international firm. Started my career in London, actually. And, there I worked with a lot of, various companies in the space on these similar problems. So, just as a starting point, one of the kind of threshold issues, that a lot of founders or a lot of questions that founders have is like, why should they care about this stuff? And is this kind of really just a legal challenge that they can kind of push off to their outside counsel or to their internal counsel? And what I try to express to them, right, is that the importance of this problem, right? This is not a contract that you're trying to get negotiated and get the best terms on. The how you launch a token is fundamental to your business, right? It will dictate it can introduce existential risk to your business. It will define the market that you can access. It will define the relationship that you have with users and customers, and it will really kind of dictate can dictate the success or failure of your business. So as a result of that, this typically isn't a process or project that founders want to hand off to third parties, right? They typically want to grab the reins here and dig in. Now, as a result of that, right, it's very important to understand, right, where kind of the boundaries are, what the limits are, and what the kind of foundational principles are that you're dealing with, right, so that you can actually kind of solve this problem yourself. You're never going to have a lawyer that's able to answer every single question, because you're going to have a lot of questions as you go through these processes. So what I like to do with our founders is basically give them kind of the foundational principles for how kind of securities laws work, how all of the various kind of legal constructs work within this space, so that they're then able to kind of go through this process and with a better understanding of what it is that they're trying to achieve from a legal perspective, so that they don't have to rely so much on third parties to give them information. Because at the end of the day, with the regulatory uncertainty in this space, right, a lot of this is kind of feeling your way through the dark, and so we're here to kind of help you along that path. So today's presentation is going to be broken down into 4 parts. When are you ready to launch a token? Some token launch strategies, hard and fast rules for token launches, and how to structure your organization. All of these presentations have papers behind them that we've written, and so you can kind of have additional resources to look to. And then obviously I'm kind of available, and I'll be over there for demo day. For each section, I will do a pause for a brief moment to do a Q&A. And so if you do have any questions at that point, feel free to jump in. So when are you ready to launch a token? This is a critical kind of piece of all of it. I will say that the number one mistake that companies make in this space is launching a token too early. And that comes with a ton of risk. Tokens do not solve problems, and they don't magically turn your product into something that will be successful. And as a result of that, there are a lot of a lot of companies try to get to the token very quickly, but at the end of the day, you really do need to put into a lot of work before you get there, and we'll walk through kind of the various components of that. First one is finding product market fit. So Jason gave a great presentation on product market fit in Web3, and I won't go into those details. I will just stress why product market fit is important ahead of time, right? As I was just saying, tokens are not kind of a magical solution to creating consumer demand, product market fit, or anything relating to a successful project. Really, what they do are they just give you leverage, and they can kind of accelerate things. And so as a result of that, you'll see a lot of companies in this space have kind of gotten to a token very quickly, because they think that that's what's going to drive users to their product. But at the end of the day, right, if the only reason that users are coming to the product is because they can get a token, they're likely going to sell that token. And then once the price depreciates so far that there's no longer kind of really a financial incentive to use the product, you're quickly going to lose your consumers. So as a result of that, right, having a product that people actually want is something that is critical. Now, this is, I don't speak lightly of this. This is a very, very hard element of all of this. As Jason said, this is kind of the whole thing about startups is trying to build something that has product market fit. Within the Web3 space, people have kind of jumped past that because they see that the token as being the product, but that's not really the case. And Eddie also gave a great presentation to you all about kind of designing the token and what it can do. So all of those things are things that need to be focused on. You need to have a clear plan with what product market fit is, clear line of sight on that before launching the token. And the reason that is so important is not only that the token can kind of really change the incentives, change user behaviors, do all sorts of things that are very, very difficult to undo. But post token launch, you are going to be operationally constrained in what you can do with your project. And as a result of that, it is very, very difficult to have a token out and then completely pivot or change course or make material changes to your underlying protocol. And as a result of that, right, your product, your protocol is somewhat, needs to be somewhat fully baked at the time you launch a token, for legal reasons that we'll get into. Right. And so really, if you've, launched a project, launched a token, and you don't have product market fit, then what you've kind of done is put yourself on a path where anything you now try and do has a lot of risk to it. And so it's really like you're in a straitjacket trying to get out. And it's not one that we've really seen people successfully be able to pivot out of. So cannot emphasize enough, product market fit is massive. So you want an actionable plan of decentralization. So in the token launch strategies portion of the presentation, we'll go into kind of why decentralization is important from a legal perspective. But it is one of the core launch strategies that we suggest projects take, given the kind of legal frameworks that apply within the Web3 space. So a plan of decentralization then becomes very, very important. And we've written, frameworks for how to put together plans of decentralization. But really what you're looking at is trying to, turn the kind of, autonomous software that you're working on, the protocol that you're working on, into public infrastructure as compared to something like a proprietary network, right? You want it to look more like email as opposed to something like Facebook. And as a result of that, right, that is a very complex project. There are, a ton of different facets where decentralization plays a role. And so if you look at, any given project, let's say a layer one blockchain, right, you need to have decentralization at the computational level. You need to have, decentralized nodes on your network, and you need to have, the decentralized validator set. You then need to have a plan for decentralized development, right? If your project is the only one, or if your team is the only one that's continuing to develop within that ecosystem, then inherently the future of that ecosystem is dependent on you, which is not decentralized. So you need to have a plan for decentralizing development. You need to have decentralized governance in some form. This doesn't just mean token-based governance. You can also have governance at the validator set or at the node level, where people are adopting, updates to the code. But at the end of the day, right, what you can't have is unilateral control over kind of the ecosystem going forward. You need to have decentralized value accrual, right? If all of the benefit and value of the system accrues to you, then that really looks like a corporate network in Web2, like a Twitter or Facebook, right? So you want value accrual to be dispersed across kind of the ecosystem. And then you need a broad, usage and accessibility. Anyone should be able to access, if this is public infrastructure, right, it should be used by a broad, swath of the public, and it should be accessible by anyone. So when you look at that, right, and the complexity of decentralization, right, it inherently leads to handing over control, right, from your company, right, to the general public. As a result of that, that is why, right, going back to the first point, why product market fit is so important to have at the outset, right, before you launch a token. because the decentralization is going to inherently make it very, very difficult, right, for you to pivot and change the product post having decentralized somewhat. Really, that is kind of why these two pieces kind of work hand in hand together and suggest that product market fit is something that you really want to have ahead of launching a token. The third piece here is having a compelling token economic model. Tokens are not magic beans. Yes, you can just create them, but at the end of the day, right, unit economics apply to tokens the same way that they apply in the real world. So what does that mean? It means that, endless incentives, paying people to use your product in ways that is completely unsustainable, really isn't going to work just because the tokens are being minted out of thin air. At the end of the day, right, all of those incentives, right, will impact the ultimate price of a token, and can lead to it collapsing. It also means, right, that tokens need some type of economic value driver to them. Now, if you look across the ecosystem, the best example of this is Ethereum, right? Which through use of use of the blockchain, fees are burned, and that burns Ethereum, and as a result of that, that provides some price stability and an economic model for the actual token. We haven't seen as many kind of successful economic models for tokens at the app layer, like within DeFi, gaming companies and things like that. But those are kind of actively being worked on in quickly, and ultimately this is fundamentally something that is necessary. Now, there are tokens that don't have economic models. Bitcoin doesn't have one, and meme coins don't really have one. But at the end of the day, if you want a project that has potential for like long-term economic success, right, you do need to have some type of economic design to the token, and you do need to be careful about incentives. It's perfectly fine to subsidize growth early on in a protocol's life, but eventually that economic model and the economic unit economics do need to come to bear. So a robust organizational structure, something that's very different in Web3 than compared to other industries, is the organizational structure that companies use, which inherently kind of depends on the decentralization. So a normal startup is typically a C corp in Delaware, or a corporation somewhere formed around the world, and that's kind of it, right? You have shareholders, and that's your whole structure. So it's fairly easy. It's fairly boring. Within Web3, it's very different. You typically have an organizational structure that includes a foundation, one that potentially includes a DAO that has token-based governance. You have your C corp, and then you also need to have kind of third parties that are brought into this ecosystem that are also developing within it. So the complexity there is much more significant. And we'll spend the fourth part of this presentation is going to be all about kind of organizational structure. So we'll get into kind of the nitty gritty on all of that. But suffice to say is that organizational structure is something that you can't really punt on, because it basically dictates how you will operate in a decentralized fashion post token launch. So as a result of that, having all of these pieces in place ahead of time, prior to token launch is critical. And these pieces take time to put in place. They can take up to 3 or 6 months to actually get foundations in place and get all of the pieces in place to actually go through with the token launch. So it's something that you need to plan for early. And then operational readiness. So there are a ton of things that are as compared to a traditional company. There are a ton of things that you need to do in order to launch a token and be prepared to have a publicly listed token. So fundraising can be very difficult, for instance, post token launch. Be sure that you have adequate runway to continue to develop and participate in your ecosystem post token launch. And so that is a very key area where a lot of projects end up failing because they haven't properly prepared for the long-term post-token launch. The mechanics of a token launch are also very complicated. There's, just for instance, establishing custodial relationships can take months, given that there aren't a ton of custodians out there. And setting up employee incentives and partnership incentives and all of that can just take a significant amount of time, and is worth getting started on early. And then you just need to be prepared about how those incentives are structured. At the end of the day, if you have a publicly listed token, an incentive that was, great when that token's price was high, might no longer have much incentive behind it if the token price is low. And so as a result of that, right, designing the incentives, making sure that you have kind of long-term, incentive alignment amongst, the people that are involved in your ecosystem is really critical. And so, these are all things that really need to be hashed out prior to the token launch, because post-token launch, again, your hands are somewhat off the wheel, and you lose a lot of control. And as a result of that, it's much harder to kind of fix these problems if you haven't kind of planned for them ahead of time. Okay, so here we'll talk about basically how do you actually go through with launching a token and what are the considerations involved to ensure that you're not on the wrong side of the law. Again, this is probably the area where you are taking on the most risk in your project's life cycle. And there's a lot of regulatory uncertainty. And so at the end of the day, you want to be very confident in what it is you're doing. There's a lot of noise in the market around like, which path you should go on. People always complain about tokens not being available to them. Anytime a project basically, takes a strategy that doesn't just result in retail investors or retail users being able to sell their tokens on the market, you do see some consternation. But obviously, you shouldn't be designing your project with the goal of kind of enriching people that were using your project just to make money. So we'll launch into these here. There's basically the way that I kind of like to go through this framework is to describe kind of what the risks are that you're dealing with, right? And then we'll talk about various strategies that you can use and what their risk profile looks like across these three vectors. So generally speaking, right, there are three real risks associated with token launches. The first one is legal. And so this results in the fact that securities laws are applicable to in the United States are applicable to tokens, and that really constrains kind of how you can issue them. Fundamentally, right, what securities laws are trying to do is protect people that are investing their money into assets, right, where those assets have high potential for information asymmetries, right? And what I mean by that is where there might be one party in the market that has a lot more information about an asset than another, and that would then allow that party to take advantage of investors. So if you think about Apple stock, right? Tim Cook and the management team at Apple has a lot of information about Apple as a company. How many units of the iPhone they've recently sold, right? That would enable them to basically trade more effectively than the general public when it comes to Apple stock. As a result of that, right, in order for Apple stock to be listed publicly, they have to disclose things about Apple to the public, right? And that whole disclosure regime is something that's been around for 80 years, and it's worked very well. Now, within crypto, right, the argument is that tokens, right, because they relate to autonomous software, right, that functions more like public infrastructure as opposed to proprietary technology like what Apple has, that you actually can design these systems to eliminate information asymmetries, such that a disclosure regime and registration under the securities laws is not necessary. So if you think about Ethereum as compared to Apple, right, you can see significant differences along that risk profile, right? Ethereum, you can see how much it's used. You can see what projects are building on it, which projects are being used the most. And you can see that there are just thousands and thousands of developers building on top of it, as opposed to a single company driving the development of the protocol. So as a result of that, right, the idea is that the information asymmetries don't exist, and there is no reliance on managerial efforts of some team, and therefore the token should not be treated like a security. And so therefore, right, should be freely tradable and treated more like a commodity like gold. So that is the legal framework for how tokens can exist in the United States, and we'll get into kind of how that impacts the launch strategy. Obviously, on the legal side, right, the SEC and the current chair have been have had a lot of animosity towards the industry. The chair has said that every digital asset other than Bitcoin is a security, but fundamentally, he doesn't have a legal basis for those statements. There very much is a pathway to launching tokens in the U.S. That is compliant. And again, Ethereum's had an ETF recently that was approved, which shows that even the SEC now believes that Ethereum is a commodity. They actually made that statement in 2018, but the current chair was playing a bit of politics and trying to basically slow the industry down. So there is a pathway, but the legal risk is significant, right? This can be existential to your company. An SEC investigation can cost over $1 million. Class action lawsuits can cost several times that. And at the end of the day, it's really important to mitigate this risk and ensure that you're on the right side of things. So then there's commercial risk. Broad token distributions can increase legal risk just because of the nature of how the laws apply. But at the same time, if you don't have a broad token distribution, then you're increasing your commercial risk, right? If you're not accessing, let's say you exclude the United States entirely from your token launch, then obviously you're taking on commercial risk because you're not accessing, U.S. persons. So the breadth of your token launch really kind of dictates what kind of commercial risk you're taking on, and as a result of that, that has to be factored in when you're deciding what your launch strategy is. And then there's operational risk, right? So the having, as I was saying, previously on getting ready for a token, right? There's a lot of operational complexity that comes with having a token. This impacts, how your communications work, how your organizational structure is set up, and how you basically continue ongoing development. So, and as I was saying, right, it's very hard to pivot your product, post token launch. So there's a lot of operational complexity that's introduced by having a token, and that's a further risk that you need to kind of be aware of as you go through, your token, or as you design your token launch. Managing these risks. So there's really 3 strategies for managing those 3 risks that we just went through. Decentralization is the primary strategy, right? So Ethereum is decentralized right now, has very good certainty under US law. And what you're basically doing here is, as I was just saying, right, you're trying to reduce the reliance of token holders on managerial efforts, right, of the initial development team, such that securities laws are not implicated. You're trying to reduce information asymmetries. The simplest way to describe the decentralization test is called the Bahamas test, right? And what that basically says is, if your team disappeared and went to the Bahamas tomorrow, right, would that impact the token price? And if it would, then the argument is that securities laws probably should apply. If it wouldn't, then the argument is that securities laws shouldn't apply. So how do you get there? We'll get into kind of how you set up your plan of decentralization, but really the core kind of thesis, right, is that you're building public infrastructure, and because of the nature of blockchains, that infrastructure can function in an autonomous way, right? And you're basically building something for other people to build on top. And if you've done that successfully, then you will be in a position where you are sufficiently decentralized and you don't need to worry about the application of securities laws. So decentralization is the best long-term strategy. It's why most people are building in Web3, right, to build these core public infrastructure properties, as opposed to building proprietary technology. But it is the most difficult, and so it does take a very long time. There is no simple, you cannot just flip a switch and become decentralized. And so, it is something that needs to be thoroughly planned out, and something that it does take a long time. As a result of that, right, the complexity of decentralization and the difficulty and the length of time that it takes to get there, other strategies are necessary, right? So let's say you can't decentralize early on. What do you do? Does that mean that you can't launch a token? No, there's other strategies. So the 2 other primary strategies are excluding the US and restricting transferability. So on excluding the US, right, that's simple. That is what it sounds like, right? You basically geo-block US persons from participation in airdrops, and you forgo US exchange listings. This is a good interim strategy. You basically design your token launch to be compliant with Regulation S, which is a securities law in the United States that your law firm will be generally pretty familiar with. The third one is restricting transferability. So basically, you issue tokens, but they're transfer restricted. So users are not able to basically go and list those tokens on a Uniswap or on a secondary exchange and trade them. Or you use off-chain points, right, which does the same thing. The whole point that you're trying to prevent, right, is from secondary markets developing for the token that US persons have access to. The idea being, right, that if no one has access to those secondary markets, then they're not going to be able to invest in the tokens. And if they're not able to invest in the tokens, then you're not really going to have a problem under securities laws. So this can also be a good interim strategy. It's not a replacement for decentralization. But it can limit the utility of incentives, right? If people are, for instance, a lot of layer one blockchain networks work by distributing tokens to people that are running, computational resources for the network. If those people need to be able to sell those tokens in order to run their network, then obviously the fact that you're using transfer restricted tokens might really impugn that incentive and really decrease its overall value to people, and that might hurt your overall network's opportunity. So, okay, so let's look at the risk profile of these. So for decentralization, right, you have very low legal risk if you can actually, get to sufficient decentralization. You have very low commercial risk because decentralization inherently enables you to have very broad token distributions, right? You can access the US market and pretty much you can access any market in the world, but it does have high operational risk, right? Decentralization is very, very inefficient. That is probably the number one complaint that founders have. It's very counterintuitive, right? As a founder, your entire life is kind of wrapped up in your startup, and it's very difficult to go from kind of building something that is solely focused on your company to flipping a switch and having that be functioning more like public infrastructure. To give you one example, like people often refer to their own project as kind of like a protocol as their project, as their company's project, when at the end of the day, it's actually a public resource if you've effectively decentralized. So the operational risk is quite high when it comes to decentralization, which is why you do want a lot of planning, and it's also why you want your entire team and your entire company to understand what the parameters are of decentralization, what the plan is, and so that you can try and mitigate that risk. Now, on the flip side, right, another one thing that you see, because decentralization is so hard, you see a lot of decentralization theater in Web3. And so what this means is people launch a token, say they're decentralized, but they're not. And they still hold significant control over their ecosystem. And they kind of are the ones pulling all the levers. Now, this is obviously very tempting because what it does is it enables you to still move very efficiently, right? So if you don't have product market fit, it's a lot better to have control than to not have control, because then you can pivot more easily. But decentralization theater kind of negates the entire legal theory upon which decentralization as a legal strategy is based, right? If you still have your hands on the wheel, if you're still controlling the ecosystem, then all of those risks I was talking about with respect to Apple, right, still apply. You're going to be able to manipulate the price of the token. You're going to have information asymmetries about your protocol, and therefore, arguably securities laws should apply to your system. So, decentralization theater is one of the things that we are, constantly trying to fight against. It is a plague within the space, and it is something that should be avoided to the extent possible. We'll go on to the exclude strategy. So here again, very low legal risk, right? If you are launching a token that is just available to non-US persons, then you're not going to have a lot of risk under US securities laws. Now, that risk isn't zero, right? Because Regulation S does have this is the way that you issue tokens outside the United States, does have a lot of requirements that you abide by. And, because blockchains are permissionless and censorship resistant, right? People can do whatever they want with those tokens. So it is somewhat impossible to limit the flow back of tokens to the United States. So the legal risk is not zero, but it is substantially reduced. And I can tell you that we've had projects that have done, excluded the US, but because of their profile have gotten, investigation letters from the SEC almost immediately. But in those instances, we've been able to very effectively tell the SEC to go pound sand, because those projects have basically, checked all the boxes with respect to how they issued their token and made sure that they were doing everything reasonable to keep it outside the US. From an operational perspective, right? So commercial risk here, though, is very high because you're excluding the US, right? So the US is probably the biggest market for, blockchain-based products. And as a result of that, excluding the US, can lead to a lot of consternation. And so it's very important, right, when you do decide on these strategies to effectively communicate, right? There is really no there's no replacement for an effective communication strategy, and it's something that you want to be very clear with users on. Finally, there's very low operational risk associated with the Reg S strategy. So when we were talking about decentralization and that introducing a lot of operational risk, this is kind of on the opposite end of the spectrum. You can still be centralized, you can still have your hands on the wheel, and you can still be adjusting your product and things like that. So as a result of that, right, the excluding the US strategy really gives you an opportunity to, let's say, lengthen the pathway to decentralization that you have, right? You can use this as at the outset to tinker with what your protocol looks like with a live token, and then eventually decentralize over time, and then prior to the token being available in the US. All right, so the restrict strategy, somewhat similar to the excluding the US strategy in terms of its risk profile. Very low legal risk, right? Now you don't want to be out there marketing your points as an investment product. You don't want to be making a complete mockery of securities laws just because you think you found a loophole. There are projects that have done that to great consternation. But at the end of the day, if used effectively, this strategy is pretty reasonably safe. It does introduce commercial risks like the exclude strategy. As I was saying earlier, it does decrease the value of incentives because people will not be able to take the tokens that they receive and sell them on secondary markets. And so if that's what you were depending on, then it's not really going to be workable. But at the end of the day, I would argue that is not really a user behavior that in most cases you want. If you're operating a Web3 game, right, you don't really want people farming tokens and then dumping them on the market, as that will, negatively impact your economy. But in the case of like a layer one or a decentralized, physical infrastructure network, it is important sometimes is important for people to be able to sell tokens to pay for the equipment hardware that they're running that keeps the network ongoing. And so in those cases, right, this is a less of an attractive option. Now, just taking a step back, how do you put all of these together, right? I spoke a little bit about using exclude strategy, but basically the restrict strategy and the exclude strategy should be viewed as kind of ways to extend your overall timeline to achieving decentralization, right? You can mix and match these strategies to basically give yourself more time to get further decentralization. So maybe that means let's say a layer one blockchain, right? And you have a decentralized validator set, but you don't really have any developers developing smart contract protocols on top of your blockchain. Well, in that case, right, it might be hard to make the argument that you're decentralized enough to be safe under securities laws. So what you could consider doing, right, is using the restrict strategy or the exclude the US strategy, right, to give yourself more time to have your protocol operational, have the token out there either outside the US or non-transferable, right, and allow more developers to come into your ecosystem. After which point, right, at some point you kind of decide, okay, now we're sufficiently decentralized, and now we know, can either allow the token to be listed in the United States, right, or you can turn on transferability with respect to the token. So really, these are about pathways, right? Let's say you're doing a Web3 game. You could do something similar where, let's say you in the US, right, you could make US persons eligible to receive non-transferable tokens. And for non-US users, right, they could receive, fully transferable tokens. And that would allow you to have, incentives within the game, right, would have, users outside the United States be able to, participate in markets. And then eventually, as your game decentralizes over time, you then, kind of remove those restrictions, right, and allow basically kind of, the full ecosystem to flourish. So there's a lot of ways to kind of mix and match these and design them. Obviously, you need to be careful not to undermine one of the strategies, right, by kind of the way that you combine these. So just as an example, right, if you're doing an exclude the US strategy, you should not be heavily marketing your token in the United States. That kind of fundamentally undermines the purpose, or you shouldn't be listing the token in the United States, right? So there are things that you need to do in order to make sure that you're firmly within these, but you can use these basically to kind of construct a strategy. So here are 5 rules to take away. These are fairly simple, but these are things that you should absolutely remember because failure to do these are catastrophic. All right, number 1, do not sell tokens to the public in the US, right? I cannot express this significantly enough. This is the number 1 fact pattern that the SEC hates. People generally stop doing this in 2017 or 18. But every kind of cycle, some creative entrepreneurs figure out ways to describe token sales to the general public in a different way, such as protocol controlled value, things like that. And there's just no excuse. At the end of the day, selling tokens to the public in the U.S. Is an own goal, and it is the most likely thing that you could do to lead to an SEC investigation and enforcement action. Number 2, make decentralization your North Star. As I was saying, the exclude the US strategy, restrict strategy are really just placeholders for ultimately getting to decentralization. Decentralization is the entire point of this technology, right? To build software that functions like public infrastructure as opposed to proprietary software. So if you are building an on-chain product, right, decentralization should be the direction that you are headed, or on-chain protocol. And there's just really no substitute for it. 3, communication is everything. I cannot stress how important communication is. Outside of selling tokens to the US public, right? The thing that most often gets companies in trouble is how they talk about their projects post token launch, right? So if you were to take 2 things away here, I would say number 1, do not talk about your token prior to launching your token. The reason for that is that the SEC could step in and stop you from launching your token, which would be very catastrophic, obviously. So don't talk about your token prior to launching it. Second, do not talk about it like it's a financial product. Don't talk about its price, right? Don't talk about how it's going to go up in value. Don't talk about it as though people should invest in it. There's a ton of different elements to communication, right? If you're decentralized, if you're pursuing the decentralization strategy, your communication needs to reflect decentralization. That means your communication needs to reflect that you're talking about public infrastructure, not about something that you control, right? That's an area where founders commonly run afoul, where they'll talk about, our protocol is doing this. It's like, no, it's public infrastructure, right? Very simple one here, right, is that your protocol, right, should be named something different from your devco, right? Consensus Ethereum, right? It's not Ethereum devco. So at the end of the day, right, these things are fairly sound fairly straightforward, but like innocuous and somewhat and seemingly inconsequential statements can be existential for your project. If you go look at the complaints filed in Coinbase, where they've listed a bunch of different tokens that are all that they say are all securities, you'll very clearly see that the statements that they've clued in on are misconstrued, but you can see why the SEC focuses on them as being evidence as to why the project is centralized. So very important to kind of get that right. Secondary markets are very kind of risky area, right? So you want to be very careful. Announcing that your project is available on a given exchange can introduce a lot of risk to your project. This is something that the SEC also clues in on. In addition, right, engaging market makers to act on U.S. exchanges is really just a sale of tokens to the U.S. public. So per Rule 1 is something that you very much want to avoid. Now, this creates somewhat of a problem where you have, there are a lot of tokens out there that have high market caps and low floats, where there's not a lot of volume out there. But there's different strategies for kind of increasing volumes, including stuff outside the United States, including using the exclude strategy and the restrict strategy to get a broader token distribution. And we don't have time to go into those, but there are ways you can kind of combat that stuff. But needless to say, right, focusing on U.S. exchanges and focusing on liquidity there and using market makers is all kind of very, very high risk activity. And then fifth, token lockups should always be at least 1 year from token launch. The SEC has, back in 2018, there was a case called Telegram where they successfully enjoined a company from being able to issue a token because of the way that the lockups were structured, right? And this is currently a very, very significant focus area for the SEC. There is really there's a legal basis for why the 1 year lockup is what it is, but this is just a fundamental thing that you should abide by. There are some projects out there now, right, that are pushing the limits on this and going across it, and I could not think that there is a better thing that you could do to get an SEC investigation letter almost immediately following your launch. So this one is a kind of no-brainer. Within Web3, projects generally are structured like this, right? You generally have four components. You have your original developer company, so that's your startup. You set up a foreign foundation, that's kind of your token issuer and your token launch vehicle. It can also be administering an ecosystem fund, right? Funding more development within the ecosystem. It can also be coordinating your decentralized governance and ongoing kind of development work. If you have token-based governance, then you'll have a DAO. Right, these can basically have some, controls over protocol upgrades, over parameter changes, and use of the treasury. Right, that kind of token-based governance in that regard, particularly over the treasury, really helps foster decentralization. If you give token holders control of the purse strings, the treasury for the ecosystem, right, then that really means that they're in the driver's seat, and that's a very kind of important fact for the overall decentralization. And then you have people that are building on top of your ecosystem, or building within your ecosystem. So if you're a layer one, these are the people that are building various smart contract protocols. If you're a smart contract protocol, these are people that are building various apps. If you look at Farcaster as a good example, this would be all of the clients that are being built on top of Farcaster currently, including Warpcast, but there's a whole host of others. So there are kind of two significant problems that have arisen as a result of these this organizational structure that companies have been using. The first is with respect to DAOs. DAOs have a lot of issues, including that decentralized governance is very hard. You should not be relying on DAOs to effectively do much of anything, right? These are, democracy is great, but it is also incredibly inefficient and is not something that is going to lead to effective solutions to, for instance, trying to find product market fit. On top of that, DAOs don't have legal existence. They don't have an ability to pay taxes, and they subject token holders to potential unlimited liability. That is pretty brutal, because if you are a founder in this space and you have put your life into this project, it's likely that a lot of your net worth is going to be wrapped up in the tokens that you receive as part of that work. And so if that entire portion of your net worth is susceptible to litigation and unlimited liability based on just holding the tokens, that's obviously not a very comfortable position for a lot of founders to be in. And then on the foundation side, because of the use of foreign foundations as token launch vehicles, there's two real problems. They're a real world component, right? So they're trusted. And so if you give them a ton of power, then really you've just shifted a lot of trust from, let's say, the devco to a board of some foundation. And then because they're foreign foundations, they often lack substance, in the sense that they, in a lot of cases, they'll just be a board, with 3 directors in the Cayman Islands. And I don't think that really fosters the level of decentralization that the space is going for. There are great examples out there, like the Ethereum Foundation. Uniswap Foundation's done a great job recently as well. But you don't want to just go through the motions here and set something up that's really just a facade and not something that actually drives decentralization. On the DAO side, one of the solutions that we've been working on is a legal entity structure in Wyoming that is called the DUNA, the Decentralized Unincorporated Nonprofit Association. That goes into effect in July. And we are currently working on with a bunch of different projects on kind of putting a pathway into place there. The DUNA comes with a lot of benefits. It's suitable for most companies within the space if they have a US nexus, but it's really kind of depends on what the economic model for their tokens is and what their governance model is. So I don't really have time to get into all of that, but I can just say that there are a lot of benefits here. The entity structure basically allows DAOs to function as DAOs. You don't need to sign up to be a member. You don't need to KYC users. They basically, the law actually abides by whatever the smart contract protocol, the governance protocol is for the DAO. And so as a result of that, it's a pretty low touch, permissionless entity structure that is very easy to put in place. And it does solve those three problems that I mentioned. It does give legal existence, it enables DAOs to pay taxes, and it does provide limited liability to token holders. On the risk side, though, it does have potential for misuse. Whenever you're kind of operating within a legal framework, you need to make sure that you're complying with that legal framework instead of ignoring it. And I would say that a lot of projects in this space, tend to be moving too quickly to taking that into account. There's potential for conflicts of law. The DUNA is only available in one state, but it is, part of a larger entity structure that's been adopted in about 30 states. And then there's some lingering tax uncertainties that we're kind of now working with the IRS on to try and solidify this structure. On the foundation side, there's really kind of two solutions to the problem of having lack of substance given their foreign nature. One, you can use a US foundation, right? This can supplement your foreign foundation structure, where your foreign foundation is really just a token issuer, and then you have a US foundation that's periodically funded, right, and that operates grant programs, helps guide decentralized governance, does BD for the project, and really just kind of focuses on building out the ecosystem. It can also be the thing that kind of manages the decentralized governance and really pushes things forward there. This is a little bit easier because people tend to find that the most talent for the within the Web3 spaces in the United States, and as a result of that, this enables you to have keep those employees in the United States, but having them work for an organization that's ultimately going to help the decentralization. The reason why I focus on the substance of these foundations is because, like, if you only have a foundation that kind of launches a token, right, and then your only other real point of weight in your ecosystem is your devco, it's really hard to argue, right, that the devco could just disappear. So you really want an organization that's going to counterbalance the devco, and is that also going to be focused on the credible neutrality of the underlying protocol, right? You want someone that is not a for-profit business that's going to try and extract all the value that it can from the ecosystem. You're going to want to have one that's trying to safeguard it as public infrastructure that anyone can build on top of, with the devco just being one entity that happens to be operating within that space. The alternative to the US Foundation is to, do in a UK subsidiary, or a subsidiary in a jurisdiction where there is a good tax treaty with the United States. So this structure basically looks like you put a UK subsidiary under your foreign foundation, and then you can employ people in the UK or in Europe that can then act for the foundation and, again, give substance, create a counterbalance of force within the ecosystem, and help, pursue greater decentralization. Thanks all.